So let me continue my story, talking about when I was first introduced to this. Because I hope you can hear how excited I am. I love this tool. I love this tool. I don't use a lot of tools. My list of tools, indicators, my preferred analysis, it's a fairly concise list. I mean, I guess to some it might be a lot, but to me it's a fairly concise list. And the reason for that is I want depth of knowledge. I don't want more width. I don't want more analysis. I want deeper analysis. And this, to me, took my charts, took my price charts, and gave them a whole new level of market psychology. I had a whole new level of understanding to the rhythm of the day. We all have cycles, right? We as human beings, we all have cycles. Some of us are morning people, some of us are night owls. We have certain hours of the day where we're just completely tired. I'll give you a great example. Somewhere between about 1:30 and 4, I could lay down for a nap. That's definitely my low energy cycle. In fact, I've noticed 10 years of Forex trading after a previous 10 years of futures and stock analysis and so forth, my work day has changed because the early part of the day is dedicated for Forex and the dollar and the Dow and the Open, and then during the middle of the day, the doldrums, I found that I wasn't doing as much. And this was before I understood the rhythm of the market, but I found I wasn't doing as much, and I would go run my errands and live my life and do the things that I wanted to do, have lunch, whatever it is, call friends, work out, whatever it may be. And then I would come back in the evening. And then it dawned on me, well, no wonder, Raghee, you're trading the overlap between Frankfurt, London, and New York. You're leaving once London and Frankfurt leave the party. You're coming back with the Asian session. Made sense. But when I looked at this data that you see here in front of you, and this is for the dollar Canada, let's go ahead and jump over to the euro US dollar. When I got a hold of this data, I thought, wow, now this completely explains this Forex rhythm that I had slowly adopted based upon price action and the way it moved and the way my trades followed through or didn't follow through and the doldrums of the day and so forth. I started to realize, okay, this is the natural rhythm of the Forex market. So now I started to understand where risk management and trade movement follow through expectations can be much better measured with this kind of information. So let's get to that. Let's understand, now that you know what we're looking at and why I'm so excited and how this was introduced to me and how it took something that I knew anecdotally and I understood from a cycle perspective and was able to basically convert that to a much more specific understanding of price movement that accompanied the financial center open and closes, and then how I then jumped over to here's how it helps me manage possible trade entries, possible follow-through, and risk management expectations. And again, these are all expectations. These are all projections. This is not going to happen this way every day, so let's examine what I mean by that. Every day there's a little bit of nuance. We know that. Where does the nuance come from? What's the leading story of the day? What are the equities markets around the world doing? What are the unexpected news events that are happening? What is the market dealing with? What are the scheduled economic events? How are they shading market psychology? These are external issues. These are issues beyond not necessarily even scheduled events, but even unscheduled events, things we always have to be ready for. But if I'm taking a look at the euro US dollars, you can see right here, and if I'm taking a look at this over the past 6 months, think about what's happened over the last 6 months in the markets. Think about it just for a moment. And obviously, probably Greece comes to mind right now. But there's so much more that has happened in the preceding 6 months. And when you consider that, this 6-month chart factors in a lot of that volatility or lack of volatility because it's using the average movement that occurs during each hour of the day as it's occurred each trading session over the past 6 months. So obviously I'm factoring in a whole lot more into this 6-month sample, events that have occurred and economic reports and so forth, than I would if I clicked on a 1-month sample, where now I'm only looking back 1 month and think of the events of the last 1 month. Okay, that's what's going to be reflected more here. This is a more near-term reflection of volatility and price movement. Each one of these bars obviously corresponds with an hour of the day. Again, this is Eastern Standard Time. military clock, Eastern Standard Time, or 24-hour clock. And you'll see that, again, 0 is midnight, 23 is 11 p.m. Each one of these green bars that you're looking at here shows you the average to the high range of pip movement, the average of the low range of pip movement, and then where price movement typically will be. I guess it's an average of an average. It's the area of probability from high to low, which is the entire bar, with the average. Okay? This high doesn't mean it represents the highest pip movement that's ever been seen over the last 1 month at 10 a.m. Don't forget, this doesn't mean that this is the highest amount of pip movement we've ever seen. This is just an average of highs, an average of lows, and then the average. I hope everyone understood that. The euro-US dollar could have moved less than, say, 19 or 20 pips over the course of the last month at, this is what, 11 a.m. And it could have moved more than about 60 pips. Again, average high, average low. But what I'm able to get now is, give or take, any particular day. And how do I know where I'm going to be along this high to low average, by the way? Again, all those fundamentals really are going to give me a good idea. Economic reports, what's the mood of the market? Is there a holiday? Is there a lot of fear? Those types of things. So if I know there's going to be a lot of economic data or events or something is happening geopolitically, or, for example, we see the riots in Greece occurring, am I likely to be on the higher end of price movement? Absolutely. The market's on edge. It's going to reflect that with higher volatility. What if I have a boring day? Bank holidays, coming up to a big holiday, worldwide holiday, leading up into Easter, Christmas, you name it. A day that has very few economic reports. Could I be somewhere in the low area? Absolutely. So I can gauge my expected price movement based upon the kind of events that might affect the psychology of the market. On average, this is what I'll expect, and I'll work higher from the average on those days where I can expect more volatility. I'll work from the average and lower on those days that lack the volatility due to, again, the different events that can heighten or decrease market participants' opinion of what's happening in the euro-US dollar. So, broken down into 1 hour chunks, I can see most often, we noticed it in the preceding dollar Canada, we're noticing it now here in the euro-US dollar, we often see the most volatile chunk of time. As I mentioned, I knew this anecdotally, but to put my finger on it in a very specific way, the large chunk of our movement is coming between 8 and 11 a.m. Why is this? Why do we see this kind of movement? Think about the euro-US dollar for a moment. The US dollar is still the reserve currency of the world, by far. And if I take a look at the kind of movement I'm seeing here, it reflects what? The most common times for economic releases in the US. That doesn't mean we ignore what happens in Frankfurt, London, and going into the close of Asia. But you'll see over and over again that typically your US session is going to be more volatile. Prices will pick up in terms of tempo and volatility and so forth, as you can see here, because the activity picks up as we lead into the Frankfurt Open, and then it picks up again as we lead into the US. Okay, so we're understanding who is coming into the market. Frankfurt and London, here in New York, the volatility that accompanies New York due to the economic releases. By the way, same rationale for the drop-off. Who's leaving the party? Frankfurt and London. And you can see how the market gets very sideways when they're gone.